development costs in the year they are incurred or amortizing them over a period of years. Finally, let us mention the choice between the FIFO, first in first out, and LIFO, last in first out, methods of valuing inventories. An obvious remark here would be that investors should not pay any attention to these accounting variables if the amounts involved are relatively small. But Wall Street being as it is, even items quite minor in themselves can be taken seriously. 2 days before the Alcoa report appeared in the Wall Street Journal, the paper had quite a discussion of the corresponding statement of Dow Chemical California. It closed with the observation that many analysts had been troubled by the fact that Dow had included a 21-cent item in regular profits for 1969, instead of treating it as an item of extraordinary income. Why the fuss? Because, evidently, evaluations of Dow Chemical involving many millions of dollars in the aggregate seemed to depend on exactly what was the percentage gain for 1969 over 1968, in this case either 9% or 41/2%. This strikes us as rather absurd. It is very unlikely that small differences involved in one year's results could have any bearing on future average profits or growth, and on a conservative, realistic valuation of the enterprise. By contrast, consider another statement also appearing in January 1971. This concerned Northwest Industries Incorporated's report for 1970. The company was planning to write off, as a special charge, not less than $264 million in one fell swoop. Of this, $200 million represents the loss to be taken on the proposed sale of the railroad subsidiary to its employees, and the balance a write-down of a recent stock purchase. These sums would work out to a loss of about $35 per share of common before dilution offsets, or twice its then current market price. Here we have something really significant. If the transaction goes through, and if the tax laws are not changed, this loss provided for in 1970 will permit Northwest Industries to realize about $400 million of future profits, within 5 years, from its other diversified interests without paying income tax thereon. What will then be the real earnings of that enterprise, should they be calculated with or without provision for the nearly 50% in income taxes which it will not actually have to pay? In our opinion, the proper mode of calculation would be first to consider the indicated earning power on the basis of full income tax liability, and to derive some broad idea of the stock's value based on that estimate. To this should be added some bonus figure, representing the value per share of the important but temporary tax exemption the company will enjoy. Allowance must be made, also, for a possible large-scale dilution in this case. Actually, the convertible preferred issues and warrants would more than double the outstanding common shares if the privileges are exercised. All this may be confusing and wearisome to our readers, but it belongs in our story. Corporate accounting is often tricky, security analysis can be complicated, stock valuations are really dependable only in exceptional cases. For most investors it would be probably best to assure themselves that they are getting good value for the prices they pay, and let it go at that. Use of average earnings. In former times analysts and investors paid considerable attention to the average earnings over a fairly long period in the past, usually from 7 to 10 years. This mean figure was useful for ironing out the frequent ups and downs of the business cycle, and it was thought to give a better idea of the company's earning power than the results of the latest year alone. One important advantage of such an averaging process is that it will solve the problem of what to do about nearly all the special charges and credits. They should be included in the average earnings. For certainly most of these losses and gains represent a part of the company's operating history. If we do this for Alcoa, the average earnings for 1961 to 1970, 10 years, would appear as $3.62, and for the 7 years 1964 to 1970 as $4.62 per share. If such figures are used in conjunction with ratings for growth and stability of earnings during the same period, They could give a really informing picture of the company's past performance. Calculation of the past growth rate. It is of prime importance that the growth factor in a company's record be taken adequately into account. Where the growth has been large, the recent earnings will be well above the 7 or 10-year average, and analysts may deem these long-term figures irrelevant. This need not be the case. The earnings can be given in terms both of the average and the latest figure. We suggest that the growth rate itself be calculated by comparing the average of the last 3 years with corresponding figures 10 years earlier. Where there is a problem of special charges or credits, it may be dealt with on some compromise basis. Note the following calculation for the growth of Alcoa as against that of Sears Roebuck and the Dow Jones Industrial Average Group as a whole. Comment: these few figures could be made the subject of a long discussion. They probably show, as well as any others, derived by elaborate mathematical treatment, the actual growth of earnings. For the long period 1958 to 1970. But how relevant is this figure, generally considered central in common stock valuations, to the case of Alcoa? Its past growth rate was excellent, actually a bit better than that of acclaimed Sears Roebuck and much higher than that of the Dow Jones Industrial Average Composite. But the market price at the beginning of 1971 seemed to pay no attention to this fine performance. Alcoa sold at only 111 halves times the recent 3-year average, while Sears sold at 27 times and the Dow Jones Industrial Average itself at 15 plus times. How did this come about? Evidently Wall Street has fairly pessimistic views about the future course of Alcoa's earnings, in contrast with its past record. Surprisingly enough, the high price for Alcoa was made as far back as 1959. In that year it sold at 116, or 45 times its earnings. This compares with a 1959 adjusted high price of 251 halves for Sears Roebuck, or 20 times its then earnings. Even though Alcoa's profits did show excellent growth thereafter, it is evident that in this case the future possibilities were greatly overestimated in the market price. It closed 1970 at exactly half of the 1959 high, while Sears tripled in price and the Dow Jones Industrial Average moved up nearly 30%. It should be pointed out that Alcoa's earnings on capital funds had been only average or less, and this may be the decisive factor here. High multipliers have been maintained in the stock market only if the company has maintained better than average profitability. Let us apply at this point to Alcoa the suggestion we made in the previous chapter for a two-part appraisal process. Such an approach might have produced a past performance value for Alcoa of 10% of the Dow Jones Industrial Average, or $84 per share relative to the closing price of $840 for the Dow Jones Industrial Average in 1970. On this basis the shares would have appeared quite attractive at their price of 571/4. To what extent should the senior analyst have marked down the past performance value to allow for adverse developments that he saw in the future? Frankly, we have no idea. Assume he had reason to believe that the 1971 earnings would be as low as $2.50 per share, a large drop from the 1970 figure, as against an advance expected for the Dow Jones Industrial Average. Very likely the stock market would take this poor performance quite seriously, but would it really establish the once mighty Aluminium Company of America as a relatively unprofitable enterprise, to be valued at less than its tangible assets behind the shares? In 1971 the price declined from a high of 70 in May to a low of 36 in December, against a book value of 55. Alcoa is surely a representative industrial company of huge size, but we think that its price and earnings history is more unusual, even contradictory, than that of most other large enterprises. Yet this instance supports to some degree the doubts we expressed in the last chapter as to the dependability of the appraisal procedure when applied to the typical industrial company, Chapter 13. A comparison of 4 listed companies. In this chapter we should like to present a sample of security analysis in operation. We have selected, more or less at random, 4 companies which are found successively on the New York Stock Exchange list. These are Eltra Corporation, a merger of Electric Autolite and Mergentile Linotype Enterprises, Emerson Electric Company, a manufacturer of electric and electronic products, Emery Air Freight, a domestic forwarder of air freight, and Emart Corporation, originally a maker of bottling machinery only, but now also in builders' hardware. There are some broad resemblances between the 3 manufacturing firms, but the differences will seem more significant. There should be sufficient variety in the financial and operating data to make the examination of interest. In Table 13.1 we present a summary of what the 4 companies were selling for in the market at the end of 1970, and a few figures on their 1970 operations. We then detail certain key ratios, which relate on the one hand to performance and on the other to price. Comment is called for on how various aspects of the performance pattern agree with the relative price pattern. Finally, we shall pass the 4 companies in review, suggesting some comparisons and relationships and evaluating each in terms of the requirements of a conservative common stock investor. The most striking fact about the 4 companies is that the current price-earnings ratios vary much more widely than their operating performance or financial condition. 2 of the enterprises, Eltra and Emart, were modestly priced at only 9.7 times and 12 times the average earnings for 1,968-1,970, as against a similar figure of 15.5 times for the Dow Jones Industrial Average. The other 2, Emerson and Emery, showed very high multiples of 33 and 45 times such earnings. There is bound to be some explanation of a difference such as this, and it is found in the superior growth of the favored company's profits in recent years, especially by the freight forwarder. But the growth figures of the other 2 firms were not unsatisfactory. For more comprehensive treatment, let us review briefly the chief elements of performance as they appear from our figures. 1. Profitability. All the companies show satisfactory earnings on their book value, but the figures for Emerson and Emery are much higher than for the other 2. A high rate of return on invested capital often goes along with a high annual growth rate in earnings per share. All the companies except Emery showed better earnings on book value in 1969 than in 1961, but the Emery figure was exceptionally large in both years. For manufacturing companies, the profit figure per dollar of sales is usually an indication of comparative strength or weakness. We use here the ratio of operating income to sales, as given in Standard & Poor's listed stock reports. Here again the results are satisfactory for all 4 companies, with an especially impressive showing by Emerson. The changes between 1961 and 1969 vary considerably among the companies. 2. Stability. This we measure by the maximum decline in per share earnings in any one of the past 10 years, as against the average of the 3 preceding years. No decline translates into 100% stability, and this was registered by the 2 popular concerns. But the shrinkages of Eltra and Emart were quite moderate in the poor year 1970, amounting to only 8% each by our measurement, against 7% for the Dow Jones Industrial Average. 3. Growth. The 2 low multiplier companies show quite satisfactory growth rates, in both cases doing better than the Dow Jones Group. The Eltra figures are especially impressive when set against its low price-earnings ratio. The growth is of course more impressive for the high multiplier pair. 4. Financial position. The 3 manufacturing companies are in sound financial condition, having better than the standard ratio of $2 of current assets for $1 of current liabilities. Emery Air Freight has a lower ratio, but it falls in a different category, and with its fine record it would have no problem raising needed cash. All the companies have relatively low long-term debt. Dilution note: Emerson Electric had $163 million of market value of low dividend convertible preferred shares outstanding at the end of 1970. In our analysis we have made allowance for the dilution factor in the usual way by treating the preferred as if converted into common Monday. This decreased recent earnings by about 10 cents per share, or some 4%. 5. Dividends. What really counts is the history of continuance without interruption. The best record here is Emerson, which has not suspended a payment since 1902. Eltra's record is very good, Emerson's quite satisfactory, Emory Freight is a newcomer. The variations in payout percentage do not seem especially significant. The current dividend yield is twice as high on the cheap pair as on the dear pair, corresponding to the price-earnings ratios. 6. Price history. The reader should be impressed by the percentage advance shown in the price of all four of these issues, as Mia should, from the lowest to the highest points during the past 34 years. In all cases the low price has been adjusted for subsequent stock splits. Note that for the Dow Jones Industrial Average the range from low to high was on the order of 11 to 1, for our companies the spread has varied from only 17 to 1 for Emerson to no less than 528 to 1 for Emory Air Freight. These manifold price advances are characteristic of most of our older common stock issues, and they proclaim the great opportunities of profit that have existed in the stock markets of the past. But they may indicate also how overdone were the declines in the bear markets before 1950 when the low prices were registered. Both Eltra and Emerson sustained price shrinkages of more than 50% in the 1969-70 price break. Emerson and Emory had serious, but less distressing, declines. The former rebounded to a new all-time high before the end of 1970, the latter in early 1971. General observations on the four companies. Emerson Electric has an enormous total market value, dwarfing the other three companies combined. It is one of our goodwill giants, to be commented on later. A financial analyst blessed, or handicapped, with a good memory will think of an analogy between Emerson Electric and Zenith Radio, and that would not be reassuring. For Zenith had a brilliant growth record for many years. It too sold in the market for $1.7 billion in 1966, but its professorites fell from $43 million in 1968 to only half as much in 1970. And in that year's big sell-off its price declined to $221?2 against the previous top of 89. High valuations entail high risks. Emory Air Freight must be the most promising of the four companies in terms of future growth. If the price-earnings ratio of nearly 40 times its highest reported earnings is to be even partially justified. The past growth, of course, has been most impressive. But these figures may not be so significant for the future if we consider that they started quite small, at only $570,000 of net earnings in 1958. It often proves much more difficult to continue to grow at a high rate after volume and profits have already expanded to big totals. The most surprising aspect of Emory's story is that its earnings and market price continued to grow apace in 1970, which was the worst year in the domestic air passenger industry. This is a remarkable achievement indeed, but it raises the question whether future profits may not be vulnerable to adverse developments. Through increased competition, pressure for new arrangements between forwarders and airlines, etc. An elaborate study might be needed before a sound judgment could be passed on these points, but the conservative investor cannot leave them out of his general reckoning. Emerson and Eltra. Emerson has done better in its business than in the stock market over the past 14 years. In 1958 it sold as high as 22 times the current earnings, about the same ratio as for the Dow Jones Industrial Average. Since then its profits tripled, as against a rise of less than 100% for the Dow, but its closing price in 1970 was only a third above their 1958 high, versus 43% for the Dow. The record of Veltra is somewhat similar. It appears that neither of these companies possesses glamour or sex appeal, in the present market, but in all the statistical data they show up surprisingly well. Their future prospects? We have no sage remarks to make here, but this is what Standard & Poor's had to say about the four companies in 1971. Veltra long-term prospects. Certain operations are cyclical, but an established competitive position and diversification are offsetting factors. Emerson Electric, while adequately priced, at 71, on the current outlook, the shares have appeal for the long term. A continued acquisition policy international program suggests further sales and earnings progress. Emery Air Freight, the shares appear amply priced, at 57, on current prospects, but are well worth holding for the long pull. Emart, although restricted this year by lower capital spending in the glass container industry, earnings should be aided by an improved business environment in 1972. The shares are worth holding, at 34. Conclusions. Many financial analysts will find Emerson and Emery more interesting and appealing stocks than the other two, primarily, perhaps, because of their better market action, and secondarily because of their faster recent growth in earnings. Under our principles of conservative investment, the first is not a valid reason for selection, that is something for the speculators to play around with. The second has validity, but within limits. Can the past growth and the presumably good prospects of Emery Air Freight justify a price more than 60 times its recent earnings? One. Our answer would be, maybe for someone who has made an in-depth study of the possibilities of this company and come up with exceptionally firm and optimistic conclusions, but not for the careful investor who wants to be reasonably sure in advance that he is not committing the typical Wall Street error of over-enthusiasm for good performance in earnings and in the stock market. The same cautionary statements seem called for in the case of Emerson Electric, with a special reference to the market's current valuation of over $1 billion for the intangible, or earning power, factor here. We should add that the electronics industry, once a fair-haired child of the stock market, has in general fallen on disastrous days. Emerson is an outstanding exception, but it will have to continue to be such an exception for a great many years in the future before the 1970 closing price will have been fully justified by its subsequent performance. By contrast, both Veltra at 27 and Emart at 33 have the earmarks of companies with sufficient value behind their price to constitute reasonably protected investments. Here the investor can, if he wishes, consider himself basically a part owner of these businesses, at a cost corresponding to what the balance sheet shows to be the money invested therein. The rate of earnings on invested capital has long been satisfactory, the stability of profits also, the past growth rate surprisingly so. The two companies will meet our 7 statistical requirements for inclusion in a defensive investor's portfolio. These will be developed in the next chapter, but we summarize them as follows. 1. Adequate size. 2. A sufficiently strong financial condition. 3. Continued dividends for at least the past 20 years. 4. No earnings deficit in the past 10 years. 5. 10-year growth of at least 1/3 in per share earnings. 6. Price of stock no more than 11(2 times net asset value. 7. Price no more than 15 times average earnings of the past 3 years. We make no predictions about the future earnings performance of Veltra or Emart. In the investor's diversified list of common stocks there are bound to be some that prove disappointing, and this may be the case for one or both of this pair. But the diversified list itself, based on the above principles of selection, plus whatever other sensible criteria the investor may wish to apply, should perform well enough across the years. At least, long experience tells us so. A final observation. An experienced security analyst, even if he accepted our general reasoning on these four companies, would have hesitated to recommend that a holder of Emerson or Emery exchange his shares for Eltra or Emart at the end of 1970 unless the holder understood clearly the philosophy behind the recommendation. There was no reason to expect that in any short period of time the low multiplier duo would outperform the high multipliers. The latter were well thought of in the market and thus had a considerable degree of momentum behind them, which might continue for an indefinite period. The sound basis for preferring Eltra and Emart to Emerson and Emery would be the client's considered conclusion that he preferred value-type investments to glamour-type investments. Thus, to a substantial extent, common stock investment policy must depend on the attitude of the individual investor. This approach is treated at greater length in our next chapter. Chapter 14. Stock Selection for the Defensive Investor. It is time to turn to some broader applications of the techniques of security analysis. Since we have already described in general terms the investment policies recommended for our two categories of investors, it would be logical for us now to indicate how security analysis comes into play in order to implement these policies. The defensive investor who follows our suggestions will purchase only high-grade bonds plus a diversified list of leading common stocks. He is to make sure that the price at which he bought the latter is not unduly high as judged by applicable standards. In setting up this diversified list, he has a choice of two approaches: the Dow Jones Industrial Average type of portfolio and the quantitatively tested portfolio. In the first, he acquires a true cross-section sample of the leading issues, which will include both some favored growth companies, whose shares sell at especially high multipliers, and also less popular and less expensive enterprises. This could be done, most simply perhaps, by buying the same amounts of all 30 of the issues in the Dow Jones Industrial Average. Dow Jones Industrial Average. 10 shares of each, at the 900 level for the average, would cost an aggregate of about $16,000.10 on the basis of the past record. He might expect approximately the same future results by buying shares of several representative investment funds. His second choice would be to apply a set of standards to each purchase, to make sure that he obtains 1. A minimum of quality in the past performance and current financial position of the company, and also 2. A minimum of quantity in terms of earnings and assets per dollar of price. At the close of the previous chapter we listed 7 such quality and quantity criteria suggested for the selection of specific common stocks. Let us describe them in order. 1. Adequate size of the enterprise. All our minimum figures must be arbitrary and especially in the matter of size required. Our idea is to exclude small companies which may be subject to more than average vicissitudes, especially in the industrial field. There are often good possibilities in such enterprises, but we do not consider them suited to the needs of the defensive investor. Let us use round amounts, not less than $100 million of annual sales for an industrial company and not less than $50 million of total assets for a public utility. 2. A sufficiently strong financial condition. For industrial companies, current assets should be at least twice current liabilities, a so-called 2-to-1 current ratio. Also, long-term debt should not exceed the net current assets, or working capital. For public utilities, the debt should not exceed twice the stock equity, at book value. 3. Earnings stability. Some earnings for the common stock in each of the past 10 years. 4. Dividend record. Uninterrupted payments for at least the past 20 years. 5. Earnings growth. A minimum increase of at least 1/3 in per share earnings in the past 10 years using 3-year averages at the beginning and end. 6. Moderate price earnings ratio. Current price should not be more than 15 times average earnings of the past 3 years. 7. Moderate ratio of price to assets. Current price should not be more than 11 2 times the book value last reported. However, a multiplier of earnings below 15 could justify a correspondingly higher multiplier of assets. As a rule of thumb, we suggest that the product of the multiplier times the ratio of price to book value should not exceed 22.5. This figure corresponds to 15 times earnings and 11?2 times book value. It would admit an issue selling at only 9 times earnings and 2.5 times asset value, etc. General comments. These requirements are set up especially for the needs and the temperament of defensive investors. They will eliminate the great majority of common stocks as candidates for the portfolio, and in two opposite ways. On the one hand, they will exclude companies that are 1. Too small, 2. In relatively weak financial condition, 3. With a deficit stigma in their 10-year record, and 4. Not having a long history of continuous dividends. Of these tests, the most severe under recent financial conditions are those of financial strength. A considerable number of our large and formerly strongly entrenched enterprises have weakened their current ratio or overexpanded their debt, or both, in recent years. Our last two criteria are exclusive in the opposite direction, by demanding more earnings and more assets per dollar of price than the popular issues will supply. This is by no means the standard viewpoint of financial analysts. In fact, most will insist that even conservative investors should be prepared to pay generous prices for stocks of the choice companies. We have expounded our contrary view above. It rests largely on the absence of an adequate factor of safety when too large a portion of the price must depend on ever-increasing earnings in the future. The reader will have to decide this important question for himself after weighing the arguments on both sides. We have nonetheless opted for the inclusion of a modest requirement of growth over the past decade. Without it, the typical company would show retrogression, at least in terms of profit per dollar of invested capital. There is no reason for the defensive investor to include such companies, though if the price is low enough they could qualify as bargain opportunities. The suggested maximum figure of 15 times earnings might well result in a typical portfolio with an average multiplier of, say, 12 to 13 times. Note that in February 1972 American Telephone and Telephone sold at 11 times its 3-year and current earnings, and Standard Oil of California at less than 10 times latest earnings. Our basic recommendation is that the stock portfolio, when acquired, should have an overall earnings price ratio the reverse of the PE ratio at least as high as the current high-grade bond rate. This would mean a PE ratio no higher than 13.3 against an AA bond yield of 7.5%. Application of our criteria to the Dow Jones Industrial Average at the end of 1970. All of our suggested criteria were satisfied by the Dow Jones Industrial Average issues at the end of 1970, but two of them just barely. Here is a survey based on the closing price of 1970 and the relevant figures. The basic data for each company are shown in tables 14.1 and 14.2. 1. Size is more than ample for each company. 2. Financial condition is adequate in the aggregate, but not for every company. 2. 3. Some dividend has been paid by every company since at least 1940. 5 of the dividend records go back to the last century. 4. The aggregate earnings have been quite stable in the past decade. None of the companies reported a deficit during the prosperous period 1961-69, but Chrysler showed a small deficit in 1970. 5. The total growth comparing 3-year averages a decade apart was 77%, or about 6% per year. But 5 of the firms did not grow by 1/3. 6. The ratio of year-end price to 3-year average earnings was $839 to $55.50 or 15-1 right at our suggested upper limit. 7. The ratio of price to net asset value was $839 to $562, also just within our suggested limit of 11?2 to 1. If, however, we wish to apply the same 7 criteria to each individual company, we would